Welcome friends for the fourth video of the Ind AS series. We will be discussing Ind AS 7 statement of cash flows in the current video. If you have any questions on this particular standard or any other standard which has been already covered, you can send your questions to my email ID so that I can combine all those questions and will have a separate session of Q&A answering all your questions and uh, provide clarifications for the facts which has been provided to me by you. Let's move on to this particular session on statement of cash flows, Ind AS 7. The fundamental question which comes to our mind is that we have a balance sheet which shows what is the statement of affairs of the entity. And we also have a statement of profit and loss account which shows what is the profit or loss for the particular year. In that scenario, why Ind AS requires one more component of the financial statement called cash flow statement to be provided as an integral part of the financial statement. If you take the case of statement of profit and loss, it only gives a summary of all the revenues and expenses and also shows what is the result for the particular period, whether it's a profit or loss of the entity for the given period. However, when we take the case of a statement of cash flows, the cash flows generated by the entity in the operating activities, in the investing activities, and in the financial activities are shown as separate parts of the statement of cash flows. That means independently, the cash flows generated from operating activities, cash flows generated from investing activities, and the cash flows generated from financing activities are shown as part of the statement of cash flows. Let's take a case where the cash flows generated from the activities which are operating in nature of the entity shows that what is the cash received or cash used in the company's core operational activities. For example, what is the total cash generated or net cash generated in the ordinary course of business in which the entity has engaged is what is the cash flow from operating activities. Suppose the profit and loss account shows profit and the operating activities, the net cash flow shows a negative. There is a gap between what is the cash flows uh, actually generated and what is shown as the profit as per the profit and loss account. So the moment the gap increases, there is a bigger concern. That means the company is able to make profits, but it is not able to collect its cash from its activities. Maybe it will be surviving through additional investments, uh, realizing the investments already made, or taking borrowings or further infusement of capital. So the gap between the profit and loss account and the net cash generated from the operating activities of an entity is an important consideration for anybody who is analyzing the financial statement of an entity. So only the cash flow can show this gap. If you are only having profit and loss account, we may have a situation where the company still shows a profit but not actually uh, having the required cash flows for its regular operations from activities. Let's just take this example for us to understand whatever we have discussed earlier in detail. For example, in this case, I have taken, say, for example, 2019, 2018, and 2017. 3 years has been taken as a comparative number. in which the revenue from operations, if you are seeing from 1000 million, I'm taking this as INR million, from 1000 million, it has gone to 1600 million in 2018, and it has gone to 4000 million in 2019. And the net profit after tax for the year is also consistently increasing in line with the increase in revenue from operations. For example, in 2017, it was 120 million, it was 230 million in 2018, and in the current year, it is 780 million. That shows that the company's revenue from operations are consistently increasing year on year. Net profit is also increasing year on year. Let us take the cash flow statement, in which what is the net cash realized from the operating activities during the ordinary course of the company's business. It shows in all the years as a negative net flow, and also it increases significantly from 2017 to 2019. So in simple terms, the revenue from operation increases significantly year on year, but the entity has negative cash flows from operating activities every year. That also increases significantly year on year. This is a clear red flag as far as the company's operations are concerned. When the revenue and income are reported on a year-on-year increase basis, but only little cash comes in. How the company is surviving is the biggest question. Most likely, the entity may be surviving by cash flows from financing activities. That is, maybe shareholders are further infusing share capital, or it is raising long-term funds or short-term funds to survive the crisis, or it may be selling off the investments which they have already made in the property, plant, and equipment, or maybe investment made in other entities for the purposes of meeting the cash flow requirement. So the cash flow is an important tool to analyze the performance of a company rather than just a profit and loss account. So accordingly, Ind AS says cash flow statement is an integral part of the financial statement. You recollect that the components of financial statement, when we are talking about, we have seen in Ind AS 1, it's balance sheet, statement of profit and loss, statement of cash flows, statement of changes in equity, and notes and accounts. So cash flow statement is an integral part. That integral part of the financial statements are normally not considered by majority of the people who are analyzing the financial statement. So it is very, very important to look into the cash flow statement. That is the reason why there is a separate standard on cash flow, which has been provided as part of the financial statement. Let's look into the applicability of this statement for entities. If you see AS3, it has given exemptions to certain entities not to prepare cash flow statement. For example, it has exempted SMC, small and medium companies, from preparing and presenting the financial statement, where the turnover is less than 50 crore or the borrowings at any point of time is less than 10 crore. It is need not prepare any cash flow statement. So there is an exemption which was available for under AS3. Whether Ind AS 7 has given any such exemption, the answer is no. Ind AS 7 says all the entities should prepare and present their financial cash flow statement as part of their financial statement. No exemption has been given. And of course, you can also have a logical conclusion that all the entities who are adopting Ind AS 7 will be considered as a level 1 entity even under AS 3. So naturally, the exemption will not be available. Second important question comes to our mind is, when an entity presents a financial statement, whether the cash flow statement should be attached only when the financial statements are prepared for the year end. That is only for the annual financial statement, cash flow statement should be there. Or if the entity also prepares interim financial statement, it should also prepare and present cash flow statement along with the interim financial statement. It is very, very clear that the cash flow statement is an integral part of the financial statement. Accordingly, if an entity prepares either annual financial statement or interim financial statement, it should have the cash flow statement for that particular reporting period as well. The only point which we have to consider is if a complete set of financial statements have been given as part of the interim financial statement, cash flow statement should also be a complete cash flow statement. That means it's a detailed cash flow statement drawn as per Ind AS 7. Suppose if the entity presents a condensed interim financial statement, the cash flow statement can also be given in a condensed form. That's the only thing which we can have as a difference between annual reporting period and the interim period. Otherwise, the cash flow statement is considered as an integral part of the financial statement. Whenever a financial statement has been presented as part of the financial statement, cash flow statement should also be prepared and attached. The question also arises, a cash flow statement is an accounting standard or it's a disclosure standard? You know pretty well, if we are talking about an accounting standard, normally it requires adjustment in the balance sheet as well as in the statement of profit and loss. But in a cash flow statement, we use the existing balance sheet and statement of profit and loss to prepare this. It is only a disclosure standard and not an accounting standard. Anything which is arising out of preparation of the cash flow statement is not going to affect the position of the balance sheet as well as the position of the profit or loss for the particular year. So that is the reason why Ind AS 7 is considered as a disclosure standard rather than an accounting standard. Having seen the applicability, let us look into some of the key definition we have to consider. The first thing which we have to see is what you mean by operating activities. The operating activities are defined as the principal revenue producing activities. For example, if it's a trading concern, the revenue producing activities is nothing but purchase and sale of goods. So whatever profit arises after adjustment of all the expenses and the taxes is considered as the operating activities. Cash flows generated from operating activities. When we are talking about investing activities, the activities relating to acquisition and disposal of long-term assets and investments, surplus funds, which are invested in investments, or I'm purchasing long-term assets like property, plant and equipment for the operations of the entity, those items are considered as an investing activity. What do you mean by financing activity? Financing activities is actually results in changes in the size and composition of the owner's capital. For example, when there is issue of additional capital or buyback of shares or where dividends has been distributed, all these activities are happening in the changes in size and composition of the owner's capital. So to that extent, it is considered as part of your financing activities. What do you mean by cash? Cash is nothing but not only cash on hand, but also the balances with banks deposits, but where, as well as in current accounts and other accounts. Only thing is, with respect to deposits, there are some specific consideration to understand whether that is a cash equivalent. When we are saying cash equivalent, there are certain conditions which we have to check. It should be short term in nature, and it is a highly liquid investments. That means at any point of time the entity could convert that into cash. When it is readily convertible into cash, there should be insignificant risk of change in value. That means when I am disposing a highly liquid investments, I should be able to realize the carrying amount, and I should not incur huge loss in realization of that particular investment when I am converting into cash. So fixed deposits, when we are looking into this, we have to have whether it's short term in nature. Anyway, it is highly liquid investments. Anytime it can be convertible into cash, and there is no significant risk of change in value. But short term, whether it is in nature, decides whether it's a cash and cash equivalent, or in case if it is not short term in nature, it will be considered under current assets, other bank balances, or maybe non-current assets if it is going to be realized after 12 months from the end of the reporting period. In that scenario, it's a long term in nature. What do you mean by short term? The standard says anything which can be realizable within 3 months from the date of investment. In simple terms, if the original maturity of the investment, maybe it's a bond or maybe other investments or maybe bank deposits, should be capable of being realized within 3 months from the date of its investment. So the original maturity should be 3 months. Whether the 3 months has to be considered from the date of investment or from the end of the reporting date. For example, 31st March 2019. Whether I have to see whether the deposits or the investments are going to be realized within 30th June 2019 to decide whether it's a cash and cash equivalent, or I should see what is the date on which the investment has been made and what is the actual date of maturity, whether that is within 3 months period. That is what we have to look into here. So the consideration here is that 3 months of original maturity is what we have to see. Accordingly, the 3 months has to be calculated from the date of investment, and the reporting date is not the basis to determine cash equivalent. Having seen the definition of cash equivalent and other key definitions, let us move on to have some questions to us to understand the concept well. Whether the following are considered as cash equivalent, let us look into this. A overdraft facility taken from by the entity. So overdraft facility, you may know that a limit has been set up to which the company can draw the money, and of course the overdraft facility is normally given for a particular period. It may be renewed year on year, but normally it is given for a particular period. For example, a overdraft facility taken on the security of deposit, maybe 85% or 80% of the deposit is taken as an overdraft facility. What to do with that overdraft facility with respect to cash and cash equivalent, whether it should be a component of cash and cash equivalent. Interestingly, the standard says that bank overdrafts which is repayable on demand normally forms an integral part of the entity's cash management. That means an overdraft facility is for a fixed period and the entity has to naturally take that settle that amount within that particular period, and the way in which it operates is for the cash management part of cash and cash equivalent. This is one of the significant difference between AS3 and Ind AS 7. At the same time, we have a similar question. What is the situation if I am talking about cash credit limits or other working capital loans which has been taken, which is also repayable on demand? Here it says this is normally is not a cash and cash equivalent because it is a facility which has been given on a continuous basis, not for a particular period, and accordingly it should be considered as part of the financing activity and it cannot be part of the component of cash and cash equivalent. That is one of the interesting difference between how the overdraft facility has to be treated and how the cash and cash credit limits are to be treated. In fact, in one of the case where a PSU has presented the financial statement where it has some working capital limits, which is a cash credit limits. After the audit has been completed, the C&AG, when they have made a supplemental audit, specifically questioned the logic of showing the cash and cash credit limits as part of the financing activity. And it's the first year of application of Ind AS, so they also have a little bit of confusion. And they felt that every credit limit, which is short term in nature, should be part of the cash and cash equivalent. And of course, later on, explanation has been provided saying that it's not an overdraft facility, it's only a cash credit limit, which is a continuous basis. The limit will be renewed, and accordingly, it should be shown as part of the financing activities. So everybody has this confusion, and overdraft facility being component of the cash and cash equivalent is a significant difference between Ind AS and AS. Let's have some more questions. Whether these items has to be shown as part of operating activities or part of the financing activities, or it has to be shown as part of the investing activities. So this is another confusion which we normally have. Let us take some examples to understand this. Okay, so this example is also again with respect to cash and cash equivalent. For example, the company has purchased a bond on 1st December 2000, and the maturity date is next year 31st April, and the reporting date is 31st March. Whether this particular bond, assuming that there is no significant risk of change in the value and it can be convertible readily into cash, whether it will be considered as cash equivalent. The one point which we have to see is that maturity date is more than 3 months from the date of acquisition, and accordingly it cannot be cash equivalent as we have seen earlier. Suppose if company has made investment in open-ended mutual fund, whether that has to be considered as cash equivalent? No, because it's not short-term in nature. Normally, when an investment has been made in an open-ended mutual fund, it is long-term in nature, and the investment is also subjected to significant risk of realization in the cash value, and to that extent, it is not considered as cash equivalent. Some cases, banks will insist that you have to mandatorily maintain certain balances with the banks. It's maintained on a long-term basis. A current account being maintained, they will say that the minimum balance to be maintained may be, say, for example, 1 lakh rupees or 2 lakh rupees. Whether that 1 lakh rupees and 2 lakh rupees is always with the bank. And to that extent, whether it will be having the nature of cash equivalent, the answer is still yes, because it is to be maintained on a rolling basis. So we will not say that it's the amount has been earmarked and fixed and it is actually maintained on a rolling basis. So accordingly, the entire balance in the current account, even if there is a stipulated amount to be maintained on a mandatory basis as a minimum balance, that should be treated as part of the cash equivalent. Deposits repayable within 24 hours notice, no loss of interest. That means there is no change, significant risk of change in value. Definitely it is qualified as a cash equivalent. Cash and cash equivalent in a subsidiary, and assuming that the subsidiary has a severe long-term restriction of transferring the funds to the parent company. So how this cash and cash equivalent, this particular item should be treated in the standalone financial statement of the subsidiary. As far as the subsidiary is concerned, it's a short-term in nature, readily convertible into cash, and there is no significant risk of value change in value. Accordingly, in the standalone financial statement of the subsidiary, it will still meet the criteria of cash equivalent. Suppose if you ask the same question, what you will do in the consolidated financial statement of the group? If we ask that question, the answer could be different, because the amount could not be transferred to the parent company because of severe long-term restriction of funds by the subsidiary to the parent company. And accordingly, it is not short-term as far as the group is concerned when it prepares and presents a consolidated financial statement. And accordingly, the cash equivalent of a subsidiary will not necessarily become the cash equivalent in the consolidated financial statement as well. Okay, let's move on to understand. We have seen a lot of definition relating to the activities of operating activities, investing activities, financing activities, etc. The only question which we are having is that how it will be presented in a cash flow statement. So the cash flow statement will be presented. The first part of that will be showing what is the cash flows generated on a net basis from operating activities, what is the net cash flow generated on investing activities, what are all the items which constitute that cash flows, inflows and outflows of cash, and what is the inflows and outflows of cash, and what is the net cash generated or used in financing activities. This is the way in which the cash flows will be presented as part of the financial statement. This we have already seen what is the definition of operating activities, investing activities, and financing activities. Let's just have a quick look of a published financial statement to understand this more clearly, because an Excel spreadsheet working can help you to understand better how the cash flow statement is being structured. As you see here, you can see that the cash flow statement which is being given by a listed entity to whom Ind AS 7 is applicable. As we have said, it is for the year ended. It is not a cash flow for a particular period. It is not for a particular date. It is for the particular period. So it is like a profit and loss account. It's a statement of cash flows for the entire year or for the reporting period. It may be period ended or it may be year ended. Period ended means the entity is preparing interim financial statements. Okay. So the first part of the cash flow statement will be cash flows from operating activities. So here one thing which I have shown is this cash flow has been generated or presented using indirect method of cash flow. There is also a method called direct cash flows where the actual cash collected by sales will be shown, actual expenditure on purchases will be shown separately, the actual expenditure on employee cost will be shown separately. So the expenditure will be shown separately, but here it starts with an indirect method of starting with the profit before income tax and make adjustment for the non-cash items to arrive at what is the cash generated. And one thing which I have highlighted in yellow, fair value changes of investment considered in the profit and loss account. What does it mean? Ind AS 109 requires certain investment to be considered on fair value at every reporting period, but it may not have been actually realized by means of sale. So it is also a non-cash item, only to show that all other items we have already seen even in AS3 presentation. The next point which we are seeing is that after the profit and loss is adjusted for non-cash item, it has to be further adjusted or increased or decreased for the changes in working capital. And we are saying working capital, it normally on current assets and non-current assets and other liabilities, and not relating to assets which are forming part of the investing activities or financing activities. Whatever assets which are used for the purposes of the operating activities, any changes arising out of that is normally considered as a working capital change. For example, what is the increase or decrease in loans and advances? For example, if there is a decrease in loans and advances, it increases the, it is actually decreases the, sorry, it increases the cash flow available, because when I have 10 lakhs of loans which has been there and now it has reduced to only 5 lakhs means I have collected 5 lakhs. So if there is a decrease in assets, it will actually increase the cash flows. If there is an increase in assets, it will decrease the cash flow. That is the reason why increase is shown as negative as far as asset is concerned. The ulta will be the case where it is a liability. And now we are arriving at profit as per profit and loss account adjusted for non-cash items. After that, adjusting for working capital changes, arrived at what is the cash generated from operations. But the income tax payment is relating to the operational activity, and accordingly, the entire income tax paid net of refunds will be shown as an outflow, and this is shown as the net cash from operating activities. Then we go to the investing activities. Any investment in long-term assets are considered as part of this, where, for example, PPE, purchase of PPE, sale of PPE, investments which has been made or realized, investment in fixed deposits. Why investment in fixed deposit is shown as part of the investing activities? Please recollect, we said what can go as cash and cash equivalent with respect to bank deposit is only if the original maturity is 3 months or less, right? So any fixed deposit which is having more than 3 months of original maturity will be classified as part of bank balances other than the above. If it is current, it is normally get adjusted here, but we should not consider that as part of hit because it is like investment of the surplus funds in another entity. Here it's a bank, so it should be treated as part of the investment activity. Any income resulting from investment which I have made in other entities, any loan which I have given to others for which I have collected interest, all those items are also cash flows arising out of investing activities. So the second is the net cash may be used or may be received from operating activities. In this case, first year there is a net cash received from investing activities. In the second case, it is a net cash used in investing activities. The third part of the cash flow statement, as we have already seen, is the cash flows from financing activities. That is where long-term loans, short-term loans, and share capital increase, decrease, dividends payments, finance cost which has been paid, all those items will come as part of the financing activities of an entity. Okay, so here also it can be net cash from the financing activity or net cash used in financing activity. So we have the net decrease or increase in the cash and cash equivalent, that is from financing operating activities plus the net cash from investing activities and net cash from financing activities comes to the net increase or decrease in cash and cash equivalent. With this, we will add the opening cash and cash equivalent from the previous year, and this will be the cash and cash equivalent at the end of the year. This cash and cash equivalent should always be reconciled with the cash and cash equivalent which we are showing in the balance sheet as cash and cash equivalent. So that is the reason why it requires to have a disclosure of, I can consider it as a reconciliation or I can show it as a component of what constitutes cash and cash equivalent. Current account balances and cash on hand. In this case, there is no fixed deposit, and accordingly, the worry of seeing whether it has original maturity of less than 3 months is not there. It's all deposits are more than 3 months of original maturity, so it becomes a part of the investing activity. And another thing which we are supposed to give as a note is to show whether the cash flow has been prepared based on indirect method or direct method. Normally, cash flow statements are presented based on indirect method as provided in Ind AS 7. Even SEBI listing agreement requires the financial statement should be presented on an indirect method. Schedule 3 to the Companies Act 2013 refers the format of the cash flow statement to uh, Ind AS 7 and Ind AS 7 and Ind AS 3. But when it comes to the most preferred method of presentation of cash flows is the indirect method. And when we are doing this activity, we have one important aspect. In the first example which we have seen, the company has generated a profit of 1205 lakhs. In this case, I think it's a 5 lakh, it's in million. So it has created 1205 million of INR. But if you see, net cash which has been generated is only 141 million in the current year. Whereas in the previous year, it has created or generated 1,739 million of cash, where the profit is only 1,244.72 million. So this type of scenario shows that the company has good profits, but still it could not realize everything in cash, and naturally it depends on what is the surplus which it can generate out of investing activities or as part of the other activities. Here the investing activities actually takes care of the entire operation, so it has actually disposed its investments to the extent of nearly 46.44 crore. That is the reason why we have to be always cautious to see how the cash flows are being generated vis-a-vis the profit reported by the entity. Another thing which I normally use as part of the process of cash flows statement is we maintain some standard template for the cash flow working. This is what we maintain for each item there in the balance sheet. It is actually linked here, and whatever non-cash adjustment which I am trying to do. For example, here I have adjusted a non-cash item of profit or loss on sale of fixed asset. If you see, that item is actually appearing here, right? So what is the advantage of using this current year number, previous year number? What is the change? Whatever we are having, this will help us to ensure that how the numbers taken from the financial statement to the cash flow statement. One. The second is reconciling the number is also easier when there are a lot of non-cash adjustments which has to be made. So similarly, for the previous year also we have done the cash flow working. So I strongly encourage people to have a standard template of cash flow working forming part of the financial statement. If you are a student preparing this type of working will help you. If you are from the industry and you are preparing the financial statement and cash flow statement is part of the financial statement, you have to prepare this with a lot of working. Always it's better to have this type of template model which will help you to understand this in a simple method, and it is also have a very good audit trail available. Let's having seen that what is the structure of the cash flow statement, let us move on to see certain aspects. Before we see certain aspects of that, the main question which we are having is operating activities is principal revenue producing activities of the entity. So accordingly, what is the nature of the entity's business will determine the classification between the three headings. Okay, so you cannot simply say that uh, for every entity we will show this particular item as operating activity, this particular item as part of the financing activity or investing activity. So you have to see what is the business of the entity. Let's take some examples to understand with respect to operating activities. So what is the cash inflows arising out of operating activity? If I am talking about a direct method, sale of goods and services, purchase of goods and services, other items of income, income which are not classified either in investing activities or financing activities, these are all inflows. And similarly, purchase of material, overheads, employee benefit expenses, taxes paid, and other items of expenditure not classified as investing activity or financing activities. These are all the items which will be normally forming part of the operating activities of this. But in an indirect method, we don't have this type of line items of the actual item. So because we are starting from profit as per profit and loss account, adjusting only the non-cash uh, income or expenditure to arrive at the cash flows generated from the operating activities. Investing activities, as we have said, any investment in long-term nature uh, are considered as outflows. Suppose if I have sold that property, plant, equipment, it becomes an inflow. Similarly, any insurance claims I have received for damage of property, plant, equipment, or any collection of loans or equity in other entity where I have made an investment in another entity's bonds or securities or shares and I have disposed of, that becomes the cash inflow. As far as the cash outflow is concerned, any acquisition of equity investment in another entity, any acquisition of debt investment in another entity, bank deposit which are having more than 3 months of maturity, purchase of property, plant, equipment, leasehold improvements made if I am taking any property as a lessee, and any other loans given, maybe through debt instruments or otherwise to other entities for the purpose of earning interest income. So this could be investing activities. The financing activities, cash inflows are issue of equity instrument, issuance bonds, and long-term and short-term borrowings from banks and other persons. Cash outflows could be dividend, principal repayments of creditors who have extended long-term credit. We have seen in inventory video that if there is a deferred payment terms have been agreed with the supplier, and we are repaying over a period of more than 3 years, more than 2 years, or more than 1 year, or beyond the normal credit period, that comes as part of the financing activity, and it's a repayment of the principal. So it is not just a repayment of a creditors, and it's not an adjustment. So you have to make a reclassification of those items. Any debentures when it is issued, or any shares which you have issued, any cost, any debt which you have issued, whatever cost of issue should be part of that. Any equity instrument issued, cost of issue of the shares should be part of that. Any repayment of the amounts borrowed, short term or long term, will be part of that. And any changes made in bank loans and the charges thereon is also part of the financing activity. This is overall, and we are also familiar with this particular situation. Only thing which may have some confusion is whether this item should be forming part of my core business activity, that is operating activity, or it should be shown under financing activities or investing activities. This is a normal question which we have in our mind. Let us have a look on these checkpoints. Interest received on loans. This confusion starts because loans are shown as part of investing activities. So even any interest is received, it also should be part of that. Why this question arises? But my answer says it depends on the nature of the business. For example, if the principal business of the entity itself is to give loans to other people, for example, it is an NBFC, then the interest received on loans is part of the core business activity of the entity, and accordingly, it will be forming part of the operating cash flows, not part of the investing cash flow. So it depends. Similarly, interest paid on deposit, I take deposit, and using that I am giving loans, it will be my operating activities. Or if I have taken that as a borrowing used for my business, then it will become part of my financing activity. So we have to be careful about what is the nature of the business based on which this particular item should be analyzed. Furniture for new branches, naturally it is assets purchased, it becomes an investing activity. I'm implementing an upgraded banking software, Again, it is purchased for long-term purposes, investing activity. New cars purchased from a Honda dealer in exchange of a old car. Here what happens is I'm exchanging a car and taking a new car. So what will happen? There is the, for example, the new car value is 10 lakhs and the exchange of the old car has been taken at 2 lakh rupees. How I have to present this, whether it will be shown as disposal of the old car at 2 lakh rupees and then new investment at 10 lakh rupees, because it's relating to the same item, similar item, and also a integrated transaction. You can show as the net balance of 8 lakhs because actual outflow in purchase is only 8 lakh rupees. So you can show that as part of this, and that will be investing activity. I'm issuing employee stock options. Where I have to place it? Operating activity, investing activity, or finance activity? The answer is interesting. It is no cash flow is arising out of issue of employee stock option. I'm not getting any money and there is no outflow. So accordingly, it is not to be considered in the cash flow statement at all. In simple terms, non-cash items are not considered as part of either the operating activities or the financing activities or the investing activities. There are some specific requirement with respect to this non-cash transactions happen during the reporting period. How it has to be dealt with in the cash flow statement, we will look into that little differently. Right? There is some specific guidance available on this, but it will not be part of any of the cash flows. So how the cash flow statement can be presented, we have already discussed that it can be based on direct method or indirect method. If it is a direct method, it is not showing what is the operating cash receipts and payments which has been made, but here it shows what is the cash receipts and payments which has been generated by means of that, because we start with adjusting from the profit as per profit and loss account. So normally the direct method is not being utilized. Very few industry specific companies, for example, insurance companies are using direct method, but preferred method is indirect method of presentation. How the presentation is there, it's a simple thing. What are all the incomes of cash nature, and then plus or minus expenses of cash nature, what is the changes in working capital is equal to from cash flows generated from operating activities, and then you have investing activities and finance activities. The plus or minus will be the opening balance will be added and you will have the closing cash and cash equivalent. This is a direct method, but normally it is not a preferred method. Indirect method, the concept itself, it focuses on identifying the non-cash transactions in the income statement and adjusting those items starting from the profit as per the profit and loss account. So net income is nothing but the profit or loss for the year, and you are adjusting the income or loss relating to non-cash nature, and then you are adjusting for the changes in working capital. That's what we have seen in the cash flows in Excel format. That gives you the cash flows from operating activities, and of course before you arrive at that, you should also adjust for the payment of taxes or net of refunds, and then you have cash flows from investing activities. It may be plus or minus. Then cash flows from financing activities, the net of ABC is that changes in cash and cash equivalent for the current reporting period. Okay, so the indirect method is the preferred method because we adjust for all incomes and expenses which do not involve any cash outflow. Okay, that's what we have seen even in the template for identifying the cash flow changes. As I have already said, if there are some non-cash financing or investing activities are there, what does it mean? They are happening, transactions are happening, investing transactions or financing transactions are happening, but they are not resulting in cash receipts or payments during the period. What could be the possibility? Maybe I exchange one asset to another asset, could be a possibility. I purchase an asset by issue of a debt instrument, could be a possibility. I purchase an asset and settle it by means of share-based payment, could be another possibility. I assume a liability in exchange of an asset, could be a possibility. So in those scenarios, there is no actual cash receipts or payments which are happening with respect to investing or financing activities. So how it has to be treated? As I have already said, it cannot be reported in the statement of cash flows, but specific disclosure either in narrative format or in a summarized format as part of the schedule should be given with respect to the activities, transactions which has happened for investing and financing activities, but are non-cash financing and investing activities. It's a specific guidance in Ind AS 7. Some of the examples I have already talked about: acquiring assets by assuming directly related liability, or exchange of non-cash assets and liabilities, or converting debt into equity, or even share-based payments. So all these items could be examples of this. Those items will not be reported in the statement of cash flows, either under investing activities or under financing activities. But a disclosure of this particular transaction will be given as part of the financial statement. It can be narrative or it can be shown on a summarized format, line items showing the amounts, etc. You can show that as a table format. It is according to the basis in which the management wants to present it. So there is no hard and fast rule. It should be only as a summarized format. It can be even as a narrative format. Having seen this, the next issue comes is, suppose if the company carried out 3-4 operations in the as part of the business, but one of the business is discontinued during the year. You remember that in the statement of profit and loss account, only the profit of or loss of the discontinuing operation will be shown as a separate line item. The revenue from that or the related expenses will not be shown as a line by line items in the statement of profit and loss account. Only the net result of the discontinued operation will be shown, and the taxes relating to discontinued operation will be shown as the separate line item in the statement of profit and loss. What I have to do with respect to cash flows from discontinued operation? The standard actually gives two options. What it says is that whether you wanted to show the cash flows from discontinuing operations separately, whether you wanted to show that as a separate position, like what you are showing in the profit and loss account. In that case, you have to show that under each of the categories, what is the cash flows arising out of operating activities, what is arising out of investing activities, what is arising out of financing activities. You have to show them separately. If you are not decided to show separately, you can do the normal cash flow statement as we have seen in indirect method or maybe as direct method. You can have them together. Okay. But only thing is you have to identify the cash flows for each category and report them as part of the notes to the cash flow statement. What is the cash flows arising out of operating cash flows for discontinuing operation, investing cash flows for discontinuing operation, financing activities for discontinued operation. It can also be part of the notes and accounts, need not necessarily be part of the cash flow statement, but preferably if it is given as part of the cash flow statement, it will be fine. Okay. Suppose if the entity wanted to use any of this method, whether they have been prohibited or mandatory use only a separate format, no, they can, it is an option, so they can use it. But if they are using the option of showing combinedly, they have to show the individual cash flows as part of the notes. If there are foreign currency transactions or foreign operations, and there are assets which are held in foreign currency, how they have to be treated as part of the cash flow statement. What it says is that translate the cash flows to currency used in the financial statement. That is, for the reporting currency, you have to translate the cash flows using the exchange rate at the time of cash flows. When the cash flow has actually happened, use the exchange rate. It may be difficult. So in that case, it says that you can use the weighted average rate. If the rate is substantially remaining the same, you can use a weighted average rate to translate the cash flows. And the difference arising out of the exchange rate differences should be shown as an adjustment to the cash and cash equivalent, as a reconciling item of cash and cash equivalent. So normally we will show net cash uh, arising from uh, net increase in cash and cash equivalent during the period, which is a aggregate of the cash flows from operating activities, investing activities, and financing activities. After that, we will have one line item, impact of exchange rate changes with respect to cash and cash equivalent as part of the reconciling item. And then the next is opening balance and closing balance will come into the picture. So you have to show this as a separate one. Majority of the cases where the bank accounts are held in foreign currency, this type of reconciliation has to come in. But unfortunately, majority of the companies are not showing this particular disclosure, even though there is a specific guidance to show them as part of the cash flow statement as a reconciliation. What are all the major disclosures the entity has to disclose? Component of cash and cash equivalent along with the reconciliation in the balance sheet. That was I have shown in the Excel sheet as a note. I have shown what is the component of cash and cash equivalent, what is the bank balances, what is the suppose in a entity, it also has overdrafts that should also be part of cash and cash equivalent. And if you have a fixed deposit having original maturity of 3 months, which is unrestricted, that should also be part of the cash and cash equivalent. Cash balances all put together, you have to show what is the component of cash and cash equivalent. However, there could be a possibility of this amount may not be equivalent to the balance sheet. In case if it is not equivalent to the balance sheet, you have to have a reconciliation. Normally this difference will arise as when there is a foreign currency items are involved. Otherwise, normally these items will match with the balance sheet. Suppose if the company decides to show for the cash and cash equivalent overdraft facility as part of the cash and cash equivalent in the cash flow statement, but shown that as part of the short-term borrowings as per schedule 3, there will be a difference. Then again the reconciliation will come. Suppose the company has certain cash and cash equivalent, but if that amount is not immediately available for use by the group, if it is material, it should be disclosed. For example, one of the disclosure requirements says that the entity has taken a term loan, but the term loan is not fully drawn. So the unutilized balance of the term loan, which is available as cash and which can be taken as a cash and cash equivalent when it is drawn. So that should also be disclosed as part of the notes and accounts. So undrawn balances should be part of the disclosure. In case if the entity loses control of a subsidiary or other businesses, that means it has sold the investment made in a subsidiary, and because of that sale it loses the control and maybe it becomes a normal financial asset, or it may be now becoming only a case of an associate entity. Then what is the total consideration paid or received, and what is the portion of the consideration which is comprising of cash and cash equivalent, and what is the cash and cash equivalent on which the control is obtained or lost. Maybe this is normally happens with respect to consolidated financial statement. When there is a consolidated financial statement where I have the cash and cash equivalent which has come from the subsidiary because I have obtained the control, I should show that as also part of that portion of this particular disclosure. So this brings us to the end of one of the integral part of the financial statement, cash flow statement as per Ind AS 7. And as we have seen, only one major difference: overdraft facility is also considered as cash and cash equivalent. Otherwise, there is no big difference between Indian GAAP, that is AS 3, as well as Ind AS 7. Whether there is anything which we have to consider as a difference between ICDS or and Ind AS 7, there is no equivalent standard in ICDS, because ICDS is for computation and disclosure of the item. So to that extent, there is no specific requirement. So there is no difference between, there is no equivalent standard under ICDS. So nothing to consider there. And as far as Schedule 3 is concerned, whether there is any difference between Schedule 3 and the accounting standard Ind AS 7 in the preparation and presentation of cash flow statement, as Schedule 3 has very categorically mentioned that cash flow statement will be prepared and presented as per this accounting standard on cash flow statement, AS3 or Ind AS 7, as the case may be. Normal companies AS3, other companies Ind AS 7. So accordingly, there will not be any change between what is the presentation requirement as per Schedule 3 as well as the cash flow statement. And this with this, I conclude this session, and I welcome all your questions, the queries which you are having with respect to specific circumstances. Happy to address them, and you can always send your questions to my email ID, and you can also send your questions to me or contact me through my mobile. I will be happy to explain the situations. Well, thank you, friends, for your patient time of watching this video, and let us see again